Today, we're going to look at a company called Public Storage, ticker symbol PSA. Now, if you're not familiar with the business, I'm sure you're familiar with what they do. Think about it. Have you ever had to move, got kicked out of your house, need a place to stay, but can't take your junk with you? Odds are you have to put it in a storage place, right? Well, this company does just that. They provide storage facilities for people like you and me to hoard all our junk. There are 5 reasons why I think this company makes for a solid investment going forward. Reason number 1, it's cheap. Cheap relative to its industry peers. Why? Management has mismanaged the company and therefore the stock has underperformed over the past 10 years. Number 2, the balance sheet, beautiful and strong. What does that mean? That means the company can buy back shares, the company can pay down debt with no problems, and the company can make acquisitions without having taken on extra debt. Number 3, it has a long entrenched board of directors. These cats have been in there since the damn Stone Age. This has to change. And going to reason number 4, Elliott Capital. If you're unfamiliar with them, take a pause for the cause, Google them, and step right back. Now you know what I'm talking about. Elliott Capital is no joke, and these guys will take a position in this company, and they are looking to dispose some of those older board of directors in favor for their own nominees. This will bring us fresh perspective, fresh ideas, and hopefully steer that stock price upward. And lastly, you get paid to wait. Duh, it pays a 3.5% dividend. Makes sense to me. Now, a little bit about the business. It was incorporated in 1980. It has about 2,500 self-storage facilities across the U.S. It has an international presence with a 35% stake in a company called, what's the name of that company? SureGuard Self-Storage. And it also has a 42% stake in another company here in the U.S. called PS Business Parks. So it has a wide footprint. Okay, quick market summary. Stock trades for about $223 a share. Yikes! Sounds expensive, but it's really not. Has a market cap of $38 billion, enterprise value of $44 billion, trailing PE about 34, forward PE about 30. Okay, that sounds high in terms of the PE, I know, but that's reflective of the market you're in. Almost everything is trading high. Quick historical trajectory of the company. As you know, they started in 1980. By 2010, Public Storage was rocking on all cylinders. They had the largest market footprint in the industry. They have benefited from first mover advantage. They invested in the business. They invested in their people. And by 2010, they owned more than 5 times the amount of storage facilities as their nearest competitor. Yet 90% was owned by more regional operators and more localized mom and pop type operations. And from an operational standpoint, because they had such a large footprint, they had cost advantages that their competitors just could not compete. So as you can see, by 2010, the sky was the limit for Public Storage. All they had to do was keep investing in their people, keep investing back in their business, stay ahead of the industry, and over the next 10 years, they were clearly set to dominate. Unfortunately, that did not happen. Why? They slowed down in investing in their business, and their competitors ramped up investment and stole market share from Public Storage. This reality is reflected in the 10-year stock chart for Public Storage and its industry competitors. As you can see, Public Storage is at the bottom, while all of its competitors have been growing throughout that 10-year period. Fast forward to 2020, in comes Elliott Capital. They know the business was undervalued, and they highlighted in an investment letter which they sent to Public Storage directors December 14th, I believe, and they have identified 3 key areas where this business is underperforming and need to make improvements in order to bring that stock price much higher. Area number 1, Public Storage has failed to invest aggressively in their strong asset base. Remember, this is a company that has the largest footprint in the self-storage industry, and they're not investing in those assets. Reason number 2, they're lagging same-store sales growth. This is because they're not investing in their people. And reason number 3, corporate governance. As I alluded to before, some of those board members were there since the Stone Age, and it's time for them to retire and get out of there. Area number 1, failure to invest aggressively in their strong asset base. From the 2010 to Q3 2020 period, Public Storage has taken a very ultra-conservative approach to capital deployment. They weren't really into taking on debt, And instead, what they would do is issue a lot of preferred stock. All the while, their competitors took on debt in a very low interest rate environment and invested in their businesses and captured market share from Public Storage. So just to give you a quick example, Extra Space increases net debt by more than 300% and its share count by almost 40%, while Public Storage increased their net debt by 73% and its share count by only 2%. As a result, Extra Space's invested capital increased by more than 250%, while Public Storage is increased by only 48%. As you can see, this helped Extra Space gain market share on Public Storage throughout this 10-year period. Also, around this 2010 period, Public Storage's competitors also started investing in this third-party management business. So you say, what's that? Well, think of it this way. You're Extra Space. You go into a small local market. There's a mom and pop operator there, husband and wife, and you say, hey, Miss Husband and Wife, hey, I tell you what, I would like to manage your business for you. I'll put up my signage. You'll benefit from my marketing campaigns. I'll manage the payroll. I'll do your accounting for you. And all you have to do is pay me a fee. Mom and pop say, hell, I get to stay home, tend to my farming, sit down and watch TV while I get paid. They sign up for the deal. What's really interesting about this is this helps the whole acquisition initiative for a company like Extra Space. Why? Because after managing this small mom and pop operation for a couple of years, mom and pop is like, hell, we living a good life here. Why don't we just sell the business? And who do you think they're going to sell it to? Obviously, they're going to sell it to Extra Space because Extra Space has been the one managing the business. So they sell it to Extra Space. Extra Space takes on another storage facility under their umbrella, hence market share increases. Public Storage, on the other hand, was sitting on the sideline sucking their thumb this whole time. They didn't get into the third-party management business until 2018, 8 years after their competitors entered this market. And as a result, Public Storage's peers increased their store count by an average of 150%. And Public Storage watched its effective market share relative to its closest competitor decrease by 2 times to 1.4 times. So you see how they're just losing ground because the management is not staying up to par on what's happening in the industry, and they're not investing in the expansion of their business. And therefore, us shareholders are getting hurt. Well, those shareholders are getting hurt. We about to make some money because we got Elliott riding with us. Number 2, lagging same-store sales growth. Right before Elliott took a position, they did some research, they reviewed some surveys, and they saw that Public Storage's customer experience ranked very low compared to its competitors. And they found that Public Storage is not investing in their employees. And in this business, your employees are the point of sale. They can, if you make these employees happy, they can upsell, cross-sell, sell more than you need, all in the name of driving sales up. So this way they can meet their sales quota and get their bonuses. But if you're not doing that, you come in that door, they're trying to get you out the door so they can go back and do whatever they were doing. Just makes sense, right? So the company needs to invest in their employees. And lastly, corporate governance. As I mentioned, some of the board members have been there some 20 years. I believe the chairman of the board was also the CEO at one point. And he, in addition to a few other board members, have presided over this whole 10-year period of underperformance. A couple of the board members were actually there for the last 20 years. A few of them have no real substantial experience in the self-storage industry other than during their tenure with Public Storage. So changes need to be made. Now, what's really interesting is Elliott Capital submitted a letter to this board on December 14th of 2020. Would you believe the next day, Public Storage brought in 3 new board members? So they're starting to make the changes, they're listening, and therefore, I think we're at the beginning of a turnaround for this company. And the final piece, according to Elliott, there's no investor presentations on their website, and their prepared, check this out, their prepared remarks on their quarterly calls have averaged 22 seconds over the past 5 years. I mean, it's obvious what that says to you. That says investors We don't give a damn about you. We're concerned about ourselves. We don't care about your concerns. We don't care about your questions. It's all about us. That, as you know, has got to change, and LEA Capital is the hedge fund to go in and make that change for us. So, if you liked the video, if you learned something from it, please share it with a friend. Please drop some comments below. I would love to interact with you. Please subscribe to the channel, hit that like button, and we'll bring you more next time. See you later. Peace.